What up, guys? It's July 19, and let's go over this market. Let's go over this earnings week that's going on. So today we had a pretty nice bull market rally. I hope that you guys were exposed to this rally by owning stocks, and you bought some stocks before they moved in a huge way today, because most of them took a leg up higher today, significantly higher, enough for you to go, man, I missed out on this rally. Hopefully that's not you, but if it is, live and learn, okay? So we're going to talk about today, we're going to talk about the market, earnings week, and about what companies have been reporting up to this week about the overall economy and what we can expect in the coming months and the strength or lack thereof of the consumer, okay? Before we get started, of course, please hit that like button, hit subscribe. Hopefully you learn something from these videos and we have some fun in the meantime, okay? Let's get to it. All right, here we go, guys. So here's the action for today on the markets. We have the Dow Jones up almost 2.5%, S&P up 2.75%, Nasdaq up over 3% on the day. Amazing move. And the Russell 2K up 3.5%. Monster moves to the upside. Monster. Amazing rally on the day. Hopefully, like I said, you were exposed to this rally. It's always fun when you have rallies like this and being exposed in a maximum way to the market, okay? We have the VIX down under 25, fairly positive. And then the U.S. 10-year bond around 3. That's also fairly positive that it hasn't spiked either up or down too much. It's been steady, holding steady throughout. We also have energy, oil, at a little bit above $100 a barrel, which I don't want to see it over $100 a barrel. I want to see it under $100 a barrel. And Brent, that's the European oil index at 107, okay? For the Europeans, oil is more expensive than Americans at the moment because of some Forex, some strength of the dollar and foreign exchange situations, okay? So today in focus, we have earnings season in focus. We're going to see the state of the economy through the eyes of Goldman, through the eyes of Bank of America, Netflix, and JB Hunt. I want to go a little bit about what they're telling us straight from the horse's mouth, okay? Not from some interpretation somewhere. This is exactly what they're telling us in their earnings conference call. These are the mega bank economic outlook, essentially, and a couple minor companies like JB Hunt, okay? Also, Netflix, not a minor company, even though it's lost a lot of market cap. We'll hear from them as well, okay? Let's get on with it. So far, here's the earnings week that we've had so far. We're already done with Monday. We're already done with Tuesday. Wednesday, tomorrow, we got Tesla and United reporting. That's one of the most important ones that I'm going to look at tomorrow. Crown Castle, sort of important. CSX, also important to me. Thursday, we got AT&T, American Airlines, Snap. Snap is interesting because of social media. Of course, social media stocks. Snap sort of kind of led the downside for social media stocks. My favorite is, of course, is Meta, formerly known as Facebook. Blackstone Group is one that I really like. That's an investment bank that's worth looking into. Nucor Steel, not interested in steel because that commodity has gone down in price. You don't want to get in front of that bus before it hits you. Okay. We also got DR Horton, important for home builders and to gain home builder sentiment and to gain what their plans are for the future, what they're waiting for. Of course, American Express for the health of the consumer. We're looking at that as well. We're going to talk a little bit about the health of the consumer. Okay. But let's get started first with what Bank of America is reporting, okay? And to give you a little bit of background before that, we're going to talk about max bearishness, which is the overall sentiment of the market lately, okay? So we're talking about profit expectations, guidance expectations, growth, inflation expectations, the fear index, forward P ratios, recession around the corner. The Federal Reserve is not in control of inflation. They don't know what they're doing. They're going to go too hard or too soft. It's max bearishment sentiment all over the place. Things have not been as bad as they've been for a long time, okay? However, if you hear what Bank of America has to say, you're going to realize that those two things don't jive, okay? And here are the quarterly highlights for their Q2 earnings seasons 2022. And they, of course, had an excellent quarter in Bank of America. And I highlighted a couple of things here for you guys to take a look and to kind of digest, because what Bank of America is saying doesn't jive with the overall market sentiment. This is why, or not this week, but last week, we saw some sell-offs that recovered quite quickly because some investors already knew what Bank of America, Wells Fargo, and Citi, which were very strong and reported things along the same lines as this, And these investors knew about them and bought stocks when they dipped, okay? So we're talking here, and this is Brian Moynihan, the CEO of Bank of America, saying the organic growth engine at Bank of America that existed pre-pandemic is back in full place here. And as you can see, that in the second quarter of 2022, this reflects in net new checking account openings, net new consumer investment accounts, net new household growth in wealth management. Remember this, wealth management, because that's a common trend across a couple companies that have reported very strong wealth management numbers, very strong loan growth across all products, and good performance by global markets and investment banking teams. Given a quarter with volatile capital markets. Yeah, understatement of the century, volatile capital markets, okay? So he goes on to say, asset quality remains very strong with net charge-offs in the second quarter still 50% below pre-pandemic levels. That doesn't speak to weakness, speaks to strength of consumer, credit quality of consumer, okay? Wealth management, we talk about this, okay? As a segment, in a period of declining market values where stocks and bonds had their worst first half and 5 years, revenues still grow in that business 7% year over year. Added more than 5,100 net new households across Merrill and Private Bank. Okay, so Merrill Lynch, Private Bank, they're talking about opening investment accounts for customers. That is very strong. This is, of course, wealth management, which takes people of significant access to wealth and cash to open these investment accounts with minimums of $1 million or $2 or $3 million to invest into bonds market in different asset classes. That speaks to strength, not weakness of the wealthier side of the consumer. Okay, it says here, U.S. consumers remain quite resilient, continue to spend at a healthy pace, even as quite some time has passed since the receipt of any stimulus. That's key. Second, the overall average deposit balances for most cohorts are higher than they were both last quarter and even rose in June versus May. Okay, is that weakness or is that strength? And if you recall the June CPI, that was the worst CPI read in 41 years, but they rose in June. The average deposit balance for most cohorts rose in June versus May. That's incredibly bullish in my opinion. Okay, now our customer data shows Bank of America customers spent the highest quarterly period on record in Q2 at $1.1 trillion in total spending. That's up 12% year over year. So we're talking about spending being up 12% year over year, and deposits being higher in June than they were in May. What else? How else can we interpret this, guys? Highest debit spending period on record for us. Highest record spending period on record for us. You have to take that in, and you have to realize that the bearish sentiment that the market was painting was probably oversold to you. And for you to be overly bearish is costing you money based on today's rally and based on the last couple of weeks of market action. Okay, in June 2022, spending was up 11.3% over June 2021. Transactions also rose more than 6% for the first 2 weeks of July. The spending is up 10% plus in transactions, again rising 6% plus. Okay, 2.2 billion in common dividends paid and net share buybacks. So is Bank of America gonna pay dividends, right, and buy back stock if they're doing poorly or if they believe the outlook is poor? Probably not. So again, incredibly positive. Card loans grew $5 billion from Q1, reflecting healthy spend levels even as payment rates remain elevated. They're talking about higher interest rates on revolving credit lines. Average FICO score, 771. I mean, guys, what else do we want to know here? Small business deposits of 177 billion grew 14% year over year. So we're talking consumer. Now we're talking business. Deposits growth rate of 14% year over year. Incredibly strong. Reflects continued reopening of small business across America and the consumer spending supporting its growth. The average balance of these accounts is more than $40,000. Again, excellent quarter by Bank of America. I think this is a stock that you could own. It's incredibly cheap with a price to earnings ratio under 10, forward PE of 10, dividend yield 2.60. Price to sales looks a little bit pricey for a bank in my opinion, but that's okay. The earnings, I think, support that. And the price to book, completely reasonable at a little bit over 1. Now we're going to move on to the next bank, and this is the investment bank, Goldman Sachs, the heart of Wall Street, okay? And I want to make it a little bit faster to not bore you guys, but these guys had a moderately good quarter. Not such a good quarter as Bank of America, but these guys are dealing with a different type of customer. So let's go over that real quick. So EPS, revenues, solid beats there. Not an issue. They're profitable. They're growing profitability, and their revenues came in above line. So very positive there, okay? They are referencing macroeconomic conditions, geopolitics, having a material impact on asset prices. Talking about stocks and bonds, market activity and confidence. Yeah, no duh, right? Now, Goldman Sachs economists say that there are signs that inflation will move lower in the second half of the year. We've talked about this in prior videos about the signs that inflation is going down. I've already called peak inflation in June. I want that to be on the record. Peak inflation in June, okay? They're saying it's still uncertain, but I'm calling it, and I'm okay with that call, okay? Now, new IPOs and mergers are the weak point. And this is something that in a lot of ways is a good thing for me, bad thing for Goldman Sachs. So Goldman Sachs makes money when a new company IPOs and they become the market maker and the facilitator of a company IPOing, or when they arrange a merger, they make money based on those transactions. They're not making that money now. For investors like myself, that's actually a good thing because we're not being flooded with IPOs and all these new shares on the market that hedge funds have to sell. Have to sell their current positions to come into these new positions, okay? Now, quarterly dividend increase, 25%. That speaks to strength, not weakness of the business. And it follows prior raises of 60% in 2021 and 50% in 2019. 1.2 billion share in buybacks. Again, guys, how weak is that? It's just not weak. That is strong. Now, of course, investment banking down 41%. Year over year. I feel your pain, Goldman Sachs, because we're all in the same boat. All the retail investors, probably worse than 41% year over year, but it is what it is, okay? Revenues for corporate lending were $352 million. That's up 121%. Very strong. Global markets up 32%. FICC, I remember what that stands for. That stands for like fixed income something clearing something, okay? Increased 50%. That's the bond market, okay? And making good money off of trading bonds. Equities down 2% year over year. Not bad at all. Wealth management up 25%. That's a common trend. We saw that in Bank of America. We've seen in Wells Fargo, in Citi. We're seeing it here in Goldman Sachs. That is a common trend, which shows us that the higher end consumer is doing just fine. No problems, okay? The plans are to slow hiring and reduce bonuses. I think it's a little bit of a gimmick from Goldman Sachs because Goldman Sachs knows very well, more than probably a lot of other businesses that are listed in the New York Stock Exchange, that when they announce that kind of stuff, the market likes it and people buy their stocks because they're considered cost measures, and investors like that. So that's why they announce those kinds of things. Now we're going to move on to the next one, which is not a bank. It's Netflix. We just reported today, and it had a pretty mixed quarter. But you would think that given a mixed quarter, their stock would perform poorly. Let's look over the stock real quick. So here we go, guys. Netflix on the day, okay? We're up 5% on the day and another 7% after hours after they reported for about, 13% on the day. Great move for Netflix on the day. Congratulations if you bought this stock under 200. Great call. You were able to identify a stock which was beat up for not the right reasons, okay? So we see here that EPS was positive. The revenues were about mixed. So positive EPS is always great because it shows that, hey, we beat profitability. We're more profitable than the street expected. Revenues came in a little bit lighter, but not so much lighter that they dropped off a cliff. That is fairly positive, I think. It's mixed for the markets, but for Netflix, under these conditions, these oversold conditions, I think it's pretty pretty much of a non-issue to me, okay? So net subscriber loss of 970,000. So you would think, oh my God, they lost almost 1 million subscribers. Well, the street expected 2 million subscribers to be lost. So take it with a grain of salt. It's still bad they lost subscribers, but 50% less than expected is a positive kind of like, a little bit of a, okay, good with bad situation, okay? They guided for 1 million subscribers for the next quarters as far as positive subscribers, but the expectation of the street was 1.8 million. So that's like that's reduced guidance. That means they're saying, hey, not 1.8, we're going to do a little bit lighter than that. But at the same time, the stock was already pricing in this action, and that's not bad enough to say, hey, we need to sell the stock more. The stock was already too beat up and can withstand this kind of action. I kind of told you guys before, watch out for stocks that go up when the quarters are mixed or bad, because that means they have bottom, and I think Netflix is one of those stocks that have bottom, okay? They also referenced some foreign exchange headwinds, of course. They're in pretty much all over the world. You can get them all over the world, and to buy their services, you're going to buy it in probably your regular currency that you use in your country. They referenced Stranger Things, which was essentially the one thing that saved their Q2. Good for them. They also referenced price changes, which have caused churn. We're talking about churn. That churn is when subscribers are lost instead of gained. That's what churn is. So it's to be expected because it's to be expected, but it was less than they initially expected. So that is a positive. But once they get farther away from those rate increases that they did at the beginning of the year, that churn should actually decrease or go away altogether. So it's expected that when they increase prices, you're going to see that churn. But as you get farther away from the churn, that goes away. Just to be clear, okay? Now, partnership with Microsoft for the advertisement subscription model. Genius, okay? This is genius. Microsoft helped out Facebook back in the day with their advertising model. I think this is going to be a great tool for Netflix to get back to glory in the stock market, okay? Which should be a matter of years, I think. But at the same time, like I said, if you bought Netflix under 200, good for you. I still think the stock is a buy, to be honest, at these levels. I think anything under 280 is okay. Anything under 200 is a steal. You're stealing money, no doubt about it. Okay, now moving on, I'm going to talk about JB Hunt. This is a transportation stock. This is a trucking business, transportation and logistics business. Okay, so they beat EPS and revenue by a pretty healthy amount. Good for them. That's not negative. Revenue growth of 32%, not negative. Operating income growth, 46%. Amazing. GAAP earnings per share growth, 50%. Incredible. So we have different companies here painting pictures not in conjunction with what the market was expecting for max bearishness, okay? They bought back stock, 1 million shares of stock bought back in Q2, okay? They're adding trucks to their business. They are referencing some negativity. We won't expect everything to be good, but they're referencing negativity and some softness in their value furniture category, and that kind of makes sense. People are not buying furniture when they're not buying houses because of the housing market is pretty much at a standstill until the Federal Reserve lowers their interest rates. Okay, then they're also referencing inflationary cost pressures on tires, parts, maintenance, and technicians, which are meaningful. But again, they're more profitable than expected, and they generated more revenue than expected. So mixed, but not terrible. What happens to the stock? Let's look at the ticker here. We can see here that today the stock pretty much moved 3% to the positive, 3.78% during the market, and then after it reported, it went down a little bit under 1%, 0.84%. So this is not a significant move to the downside of the market. This is just regular market movement, in my opinion, and the 3% move probably priced in the earnings that it reported on that day. But if you see this as a differentiation, the price to earnings ratio of 21 and forward earnings ratio of 18 make it a more expensive stock than what we've seen. It's just as expensive, or actually a little bit more expensive than Netflix, more expensive than Goldman Sachs by a long shot, and more expensive than Bank of America by a long shot. Hence, you don't see these monster moves to the upside, okay? Now we go back here to the earnings picture. Okay, so again, it's important to look at these companies when they report so you're able to determine for yourself what the economy will and will not do, whether recession is around the corner, and what to do with your investments, okay? And how fearful you should be, how invested you should be in the markets. Make up your own mind of these situations. Don't let somebody in the news tell you how the economy is doing. This is where you get your information, guys, okay? If you guys have any questions, let me know. Be happy to help you out. Please hit me up on Twitter, Instagram. Hit me up on the Discord chat. Be happy to help you in the future, okay, guys? Peace out.